one of the impacts of the Fed raising rates, as we've been hearing about in this call and others, is that we've started to actually earn something on our cash for the first time in a while. And we've had lots of clients asking questions about money markets as a cash equivalent instrument that is now paying north of 5% most often. And just last week, I had a client call up and say, Liz, what's the money market at Schwab paying right now? Or we've had clients reach out and say, is that a good option for parking cash? Or maybe feeling a bit uncertain given, what's happening geopolitically in the world right now and wanting to, take some chips off the table or keep some cash on the sidelines and wondering if money markets are a good option for that. And before we address those questions, I want to make sure we all know what money markets are. And so the money markets, the tradable money markets that we're buying for our clients, those are actually mutual funds. And those funds hold really, really short-term, high-quality debt instruments. So think treasury bills, think CDs, think really short-term corporate bonds. And they set the price at $1 per share. And the rate is based on those underlying investments that are held within the fund, and it tracks really closely to what the Fed funds rate is. But that rate can change based on what the investments in that fund are. And it's not guaranteed or locked or set. And when you hear those rates quoted, it's important to know that those are annual rates. So if you hear somebody say, hey, I'm getting 5.5% on my money market, what that means is if that money market continues to pay out at the current rate for a whole year, for a whole 12 months, and you own the fund for that whole 12 months, then your rate of return on that money market is 5.5%. So I think that's something important to note because we hear that rate thrown around, but sometimes understanding what it actually means or translates into what you're going to earn in interest on your money market can be confusing. Going back to those questions, is it good to park cash in money market? I think it really depends on what the cash is for, why you're doing it. So if you have cash that you're going to need in the next 6 to 12 months, maybe 18 months, or if you're beefing up your emergency fund, maybe you have your 3 to 6 months of living expenses in cash on the sidelines, but you're thinking now's a good time to maybe bring that up to a year of living expenses. Money markets can be great options for that. I mean, we're earning generally more in money markets than we are in our checking or savings accounts at the bank. They're pretty stable and they're liquid, meaning, we can move in and out of them. But if we're parking cash there, that's part of, our fixed income or our equity allocation, we're potentially shortchanging our future selves for what feels like an easy 5% today, or might feel like an easy 5% today. And really what I mean by that is think if you're taking cash that is part of your fixed income allocation, and remember our fixed income allocations, the purpose of that is to provide capital preservation and some stability, and in this interest rate environment, even some income. If we're taking cash that should be part of that allocation and we're parking it in money market, well, we're missing out on the opportunity to lock in the rates that we can currently earn on bonds, which are at least comparable, if not better, than what we can get in money markets. And those rates we can lock in. We can know that we're going to get them for a number of years, where money market rates are going to change. They're going to go down at some point. And when those money market rates go down, so will rates on bonds across the board. So if having fixed income or a fixed income allocation is appropriate, we don't want to miss out on the opportunity to lock in the rates that we can see on bonds today. If we're taking cash that's part of our equity allocation and we're putting it in money market, to use a phrase that Jason often uses, we're taking 10-year money and we're turning it into 10-month money. And what I mean by that is, the equity allocation, that's really for long-term growth potential. And we're not going to get that in money market. That's not the tool for long-term growth. So we want to make sure that we're not being too short-sighted with those dollars. And if we're taking money out of our equity allocation and parking it in money market because we're uncertain, there's probably a couple of things going on there. First, we're probably trying to time the market, and I use we like the royal we. We're probably trying to time the market or time a re-entry into the market. And as you've heard us say over and over again, trying to time the market can be a fool's errand. And we're waiting for some time period where we feel certain about investing in stocks. And I think that's probably unlikely, or those periods where everything feels really calm and good don't happen that often. There's always something we can point to that makes us feel uncertain about investing in equities or investing in stocks. So we just, and when times are scary, that's generally the best time to buy stocks. So we just want to make sure that we're taking the right view and not using money markets to skew our overall asset allocation. Because as Doug referenced earlier, our overall asset allocation is really about us. It's about our goals, our needs, our risk tolerance, not what's happening in the market, in the short term, or what's happening in the market today. So with those thoughts, I will open it up to the panel to see if anybody has anything to add. I know, Mike, we've had a lot of discussions about this internally, both on, the role of money markets and specifically sort of money markets versus fixed income. I'll turn it over to you if you have anything you want to add.
Yeah, for sure. I'll jump in with a quick analogy here. This is a super important topic and probably the most frequent question that we're getting from clients. I think we all know this. Successful long-term investing is a lot like exercising and eating healthy. It's about long-term results. It's about good habits. And sometimes it's about doing the hard thing in the moment and delaying instant gratification in favor of a better long-term outcome. I mean, Jason says this all the time. It's simple, but that doesn't mean it's easy. So here we are in this analogy as long-term investors eating healthy with our plate of fish and broccoli for dinner, or whatever your healthy food choice is. And what has the Fed done? They have plopped a giant bowl of ice cream down in front of all of us. That's what 5+% yields on cash are. They're like a big bowl of instant gratification. And it's really, really tempting. Believe me, I love ice cream more than anyone else on this earth, so I get it. But this is a moment where our discipline as long-term investors is being tested. Because as great as that ice cream tastes at 5%, it's not good for us long-term. It's not as good as what we can get from other investments. And Liz, you made this point very well. We can get yields higher than that in fixed income right now. We can get them for a longer period of time. And of course, we all know what history says about the earning power of the stock market on a long-term basis. And just to, I guess, finish out the analogy, in addition to being long-term unhealthy, what's the other kind of bummer about ice cream? It's that it melts. And that's exactly what's going to happen to cash yields over time. They're high right now because, as we've just discussed, we're at the peak of the Fed hiking cycle. But overnight interest rates at these levels are not here to stay. In fact, if you look at, I mentioned earlier, futures markets are showing a 0 probability of additional hikes. Well, what they are implying is that at some point in 2024, the Fed's going to start cutting overnight interest rates. And the Fed's own projections also suggest that maybe in 2024 and certainly in 2025, 2026, they're going to cut rates. Yields on cash are going to move lower in lockstep with what the Fed does during that time. So that bowl of instant gratification that we have in front of us right now is not here to stay, and certainly should not be a substitute for the long-term investments that are there as part of our financial plan.
Well, I always like to think, what are the couple of tidbits, main points that we're leaving our audience with? And I don't know about the rest of you, but for me, it's that my bowl of ice cream is melting, and my 5% rate in the bank, my money market, is probably going away. So, Mike, that's a great soundbite. Thanks for sharing that with us. There was a question in the chat about, what about CDs instead of money market? And Liz mentioned earlier your emergency fund. We always recommend that people keep some money at your local bank. You go down to the end of the corner, you use your ATM, you take money out. You should have liquid assets. That said, you know, a lot of bank accounts, my bank as well, my personal bank accounts at Chase, my personal savings account basically gives me what $1 of interest for every $10,000. It's 1 basis point, so it's very, I think it's a penny actually for every $10,000 that I hold there, and I can get 5% in a 6-month CD. So for but the question is, can you access that CD when you need to? And a CD is essentially a contract with your bank. So you need to ask that question and you need to see the answer in writing. It's all electronic now, but if you go into your bank, you can say, show me the contract and show me where, you know, I can get access to my 6-month CD in 3 days notice or 1 day notice, whatever it is. And if you can get that, rather than keeping that money in low interest rates, let's say you want to have $100,000 at your local bank for the emergency fund that Liz was talking about. If you can get that money in 24 hours or 48 hours, you're likely going to give up the interest that you earned over 6 months. But in my case, I wasn't earning any interest anyway. So for me, I've made the decision, my emergency fund is in a 6-month CD that's paying 5%. Some banks are at 5.5% right now. So hopefully that answers the question about CDs.
So I did notice that when this whole question stream came up, every panelist unmuted. Apparently we all have something to say. So, and it's an important question. I'd like to make an observation. When we started Albion in 1982, money market rates were about 20%. That's amazingly attractive ice cream. I don't know what your food analogy is for that one, Mike, but it's a heck of a bowl of ice cream. But equity prices were quite low because we'd come out of the 70s, which was a very difficult period for equities. You could buy a triple tax-free 30-year bond that was paying 12%. Now that 20% ice cream was super attractive. But when Toby and I began Albion, we went for a more balanced diet. We did not invest just in ice cream. We said, all right, we're going to own our broccoli, which was fixed income, and we're going to own our fish, which was equities. And it turned out a lot better because that ice cream melted away over the following years. And as it melted, as rates dropped, we saw the value of those other assets, of course, appreciate dramatically. So this notion of don't invest 10-year money into a 10-month offering makes a lot of sense. The CD question, I think, is a critical one. Personally, I'd rather own a money market fund with the liquidity and the diversified credit risk. If I buy a CD through my bank, I am at risk of my bank failure or my bank having problems. Clearly, FDIC insurance covers it if it's below a certain amount. But I would rather own the money market fund, which is dominated typically by treasury securities and high quality short-term paper, and I have that liquidity without giving up interest. So a lot of ways to skin that cat, but I prefer the money markets.